Hello and welcome to an FX Times Daily Market Recap. I'm CMS Forex Market Analyst Nick Nassad. Today is Tuesday, December 1st, 2009. In today's trading, we saw a return of risk appetite, which helped the euro and other higher yielders to gain against the greenback. There was easing fears over the Dubai debt crisis, and we had some positive economic data coming out from abroad, which helped to override some of the concerns about the start and stop progress of the U.S. economy. We had an ISM manufacturing report from the U.S. today that disappointed forecasts, but the release was unable to deter the gains that the euro and others had seen against the greenback. U.S. stocks did pair some of their earlier gains after the manufacturing data, but the Dow Jones Industrial Average Index was still up about 100 points in late New York morning trade. Here you see where the release came out, the U.S. ISM manufacturing PMI. In the report, we saw the index fall slightly to 53.6 from October's 55.7, so that undershot forecasts. However, if we look at new orders and production, the two main components that investors will be looking at to see if the manufacturing recovery will have continued sustainability, we see that new orders is up to 60.3%, a very high reading, and production is still at a relatively high reading, just below 60. Employment index is still positive for a second straight month, though it did fall back, and the main decline we did see was in prices. So today's data, while weaker than expected, still shows that the main components to manufacturing, that of new orders and production, are still at high levels consistent with growth in the sector. Also from the US, we had pending home sales data. So on the month for October, we had pending home sales rise 3.7%, which beat forecasts to the upside. And on the year, pending home sales are up 31.8%. This is the 9th straight time that pending home sales have risen. Now, pending home sales are those where a contract has been signed, but the transaction has not gone through yet. So there's about a 1 or 2 month window between signing and purchasing, and therefore this is used as a leading indicator for home sales. So a positive sign for the U.S. housing market. In news from the Eurozone, German unemployment fell for a 5th consecutive month in November, as the number of people out of work fell by 7,000 to 3.42 million in seasonally adjusted terms. The unemployment rate declined to 8.1% from an upwardly revised 8.2% the previous month. However, despite the falling unemployment rate, the Federal Labor Agency, said that unemployment was still set to rise in the coming months. Germany had undergone a program where hundreds of thousands of Germans shifted to part-time work in the government's plans to prevent mass layoffs. So what happens when this part-time work is run out is going to be an important indication for how the labor market in Germany responds. In a second release from Germany, we saw retail sales climb by 0.5% in October, which was close to expectations and is a rebound following 2 months of declines. German private consumption slumped in the third quarter after driving growth in the second quarter, though that was due to government's cash for clunkers scheme that is now exhausted. Now, there's still some concerns regarding consumer spending in Germany, especially if the unemployment rate begins to rise in the coming months. That'll be especially true if income gains remain muted or if we actually see incomes come under pressure. Also from the Eurozone, we saw the manufacturing PMI for November rise to 51.2 from October's 50.7, which was slightly above the preliminary estimate or flash estimate at 51.0. It's the second month in a row that the manufacturing sector has posted positive activity, and that'll be an important part to sustaining the economic recovery in the Eurozone. In the UK, meanwhile, the manufacturing PMI slid to 51.8, which disappointed forecasts on the downside and was lower than the reading we had in October. The index first moved above 50 in July, but then after 2 straight months of below 50 readings, now we have again 2 straight months of positive readings. So we have sort of a fits and starts kind of recovery in the UK manufacturing sector, but slowly but surely it is starting to grow again, and conditions are looking much better than at the start of the year. Also from the UK, we had the nationwide house price index, which for the month of November saw house prices rise 0.5%, which was slightly higher than forecast, and on the year, prices are now up 2.7%. The housing market has been performing rather well during the recovery, and it is crucially tied to this labor situation. And in the UK, the labor situation has been slightly better than expected, and that better than expected performance has probably contributed to the surprise rebound in housing prices this year. Taking a look at the pound-dollar pair, we see that the pound, just like the euro, rallied strongly against the greenback, setting a new high for this week around 1.6625. The increase in risk appetite was predominantly responsible for the rise, and we had some easing of concerns regarding the Dubai debt situation. Since UK banks have a lot of the exposure to the Dubai debt, this was a very positive development for the UK pound. Look at the dollar-yen pair. We had the greenback rise in the Asian session, as we had a surprise meeting by the Bank of Japan. The reason for the emergency meeting was in response to government criticism that the central bank wasn't doing enough to stop the yen's advance, and as a higher yen could undermine the economic recovery in Japan. Following the rise in the pair, though, we reached the 87.50 level, which acted as resistance, and then we fell back down to the 86.60 area. In our final look at a fundamental release, we had the Reserve Bank of Australia increase interest rates by a quarter point to 3.75%, a move that was widely expected by economists. The Australian economy has rebounded rapidly this year following the global financial turmoil, and since it didn't have much of the exposure to while recovery in the United States, Japan, and Europe remains feeble and unemployment rates remain high, Australia's economy has rebounded rapidly, and the unemployment situation there was much better than expected by its central bank. The reason is that the financial system in Australia avoided the dramatic collapses and bailouts that were seen in the United States and Europe, and thanks largely to strong demand from China and other Asian economies for Australia's natural resources, the economic recovery there has been much more prominent than in our other developed nations. So this was the third interest rate hike in a row by the RBA, and it seemed undeterred by the global jitters set off at the end of last week by Dubai World's decision to defer repayments of its debt. Now, since the RBA decision was priced in, we didn't have much of a reaction to it, and we actually declined slightly as the Reserve Bank of Australia cautioned about a moderation in inflation. However, as risk appetite returned to equity markets, we had a rally in the pair, and we moved above resistance, short-term resistance here in New York trading to reach the 0.9260 area. If we plot a little Fibonacci level, we see that our resistance today that I just mentioned was a 78.6% retracement of our fall on Thursday and Friday. Our earlier resistance, which came during the RBA meeting, had been at 61.8% retracement. Similarly, the US dollar-Canadian dollar pair had a strong rally in favor of the Canadian dollar on the back of risk appetite and higher commodity and equity prices. And that'll wrap up today's daily market recap. Thank you for watching, and for more news and analysis, including technical analysis updates and videos, please visit our site fxtimes.com.